my name is Peter, and in today's episode we are going to be looking at JD.com and Alibaba Group. We will do fundamental analysis using value investing approach, so it's a style of Warren Buffett's analysis. And here I have the list of 9 most important things that Warren Buffett looks at while analyzing a given stock. And today we will go for all of the 9 points for JD.com and Alibaba. We are also going to compare them to each other to see which company is better, because in my opinion both of them look very promising and have very strong fundamentals, while the price currently looks undervalued. But for sure we'll look in depth into that in a second. So first let's focus on circle of competence. As you already probably know, if you follow Warren Buffett, circle of competence is something that is quite important, because in order to make good investments you need to understand what you are doing, and the risk basically comes from the unknown, the things you don't understand, the things you don't know, etc. So that's why it's very important to invest in companies that you can understand. Hopefully this retail sector, e-commerce sectors, logistics, platforms for business to business like Alibaba, or business to customer like AliExpress, they aren't rocket science, although those companies also have different sectors and segments that we will look at in a second. So it can be a little bit more difficult to maybe understand some of the logistics or the cloud computing and other sectors of the business. Alibaba recently also announced that they will do chips similar to NVIDIA to get in on this AI boom, AI revolution. And as we can see on NVIDIA, this type of a business has huge margins, so that's great that Alibaba is going into that direction, although the stock price reacted quite quickly to that information. The price jumped 13% in one session, so the market is pricing that in quite optimistically, as we can see on all of the AI stocks. But the massive margins that come from it might be a good investment, even though it's not super heavily connected to what Alibaba is doing, at least in my opinion. But maybe they can intertwine that AI chip business even for their own use in the cloud computing sector, because they are a huge company with a lot of money. Then it's good, even if cheap technology isn't connected to their core business, to invest in sectors that show super high potential. Right, and to understand what each company is doing, what is the operational activity of them, we'll watch a short video first for JD.com, then for Alibaba. So yeah, please enjoy the short movie.
E-commerce giant JD.com is the largest retailer in China, online or offline. The company sells everything from imported seafood to household goods and luxury watches to hundreds of millions of Chinese consumers. CEO Richard Liu founded the company as a tiny offline electronics store. Today, it's the third largest.
So as it was told in the video, the owner started by selling electronics, and those were, even when the JD grew, they focused a lot on electronics and this type of products, but right now they are selling everything.
Largest internet company in the world.
Okay, this chart here is really crazy for me. I didn't know that, because looking at the JD market cap is, I think, is around 8 times lower than Alibaba, for instance. But that's because JD wasn't profitable for a long time, and their core business model isn't so return profitability heavy. So they sell a lot of goods, they have super huge revenues. As you can see, in 2017 they were the 3rd biggest company in terms of revenues, but because they have lower profitability than Alibaba, their market cap is much lower.
It is also pioneering cutting-edge technologies to transform global retail. Richard's vision was to provide consumers all over China with access to high-quality, authentic products, including in less developed regions such as his hometown in rural Jiangsu province. But because China lacked logistics and retail infrastructure, he made the bold decision to build his own network from the ground up. That network now covers 99% of China's population, reaching more households than any other distribution network, with unrivaled speed and efficiency. JD.com now has over 150,000 employees, including thousands of engineers in China and Silicon Valley. They're working on AI, robotics, drones, autonomous vehicles, and other state-of-the-art technologies that are revolutionary.
Right, so as you can see here, JD.com has a lot of technological advances. They have the drones, the robots, etc. And that might be similar to what Alibaba is doing, but JD is more focused on the delivery and the warehousing and logistics of that, while Alibaba is experimenting like Amazon with cloud computing and different sectors not connected to their core operational activity, that is matching retailers with customers.
The industry. JD operates hundreds of automated warehouses and a last-mile delivery network that can ship over 90% of orders the same or next day. JD works with and sources from the world's leading brands and suppliers, delivering high-quality, authentic, and imported goods to customers in big cities and remote rural villages. In China's most far-flung regions, its delivery drones can cut a full day's supply run down to just minutes. By tapping the vast data resources across its platforms and from its strategic partnerships.
Right, so here on the building, one of the big buildings has name Tencent on it, so another Chinese great company, and that is because JD is working close with Tencent. Tencent is promoting their business. Tencent is promoting the seller JD through their WeChat application. They have this type of application that you can do a lot of things on. It's not similar to anything we have on the West, but basically it's very popular among Chinese citizens, and through that platform, this huge company Tencent is promoting and working closely with JD.
The vast data resources across its platforms and from its strategic partnerships with Tencent, Walmart, and Google, JD is creating new experiences for shoppers to buy whatever they want, whenever and wherever they want it. This technology and infrastructure allows partners to build trust with Chinese consumers in a more efficient and sustainable way. Building on Richard's original vision, JD is now sharing this retail technology and infrastructure more broadly as a service. It is enabling the expansion of other retailers, industries, and organizations for a positive impact on society. At JD.com, the future of retail is already here.
Right, so that was for the JD. Let's now watch a short video for Alibaba. I'll speed it up a little bit.
The traditional marketplace has seen little change over the past few hundred years. You've got a buyer. The traditional marketplace has seen little change over the past few hundred years. You've got a buyer, you've got a seller, which then leads to a transaction. But over the past couple of decades, things have started to change at an unprecedented pace, and perhaps no company is reshaping that experience more than Alibaba.
Alibaba is one of the world's largest retailers. The company has more than 500 million people using its shopping apps every month. And if you're thinking its scale is limited to China, well, think again. It has operations in more than 200 countries. The company was founded by CEO Jack Ma in 1999 with 17 other people, and he knew he was onto something big.
When I have a competitor like a Google and eBay, as a Chinese local company, we can learn a lot. We can improve ourselves. They should be careful of us.
Alibaba set the record for the biggest IPO in history, which took place at the New York Stock Exchange in 2014. And this year, Alibaba was the first company in Asia to exceed the $400 billion valuation mark, an honor that had previously only been held by American companies.
Alibaba is amongst other global e-commerce giants, transforming the marketplace from this to this.
The company is made up of three main sites: Taobao, Tmall, and Alibaba.com. Combined, they have hundreds of millions of users and host millions of merchants and businesses, which means they can pretty much be used by anyone, anywhere, for anything. So how does it even work?
Right, as you can see here, there is Taobao, Tmall, Alibaba.com, but there is no AliExpress. And for a Western customer, that can be very weird because often when we think of AliExpress, we think of Alibaba Group. And that is because this is what we see. This is the product for us. But in reality, Alibaba Group isn't focused so much on AliExpress, as a lot of the profits from this company come strictly from China. This is why in the recent years after the COVID pandemic, when the Chinese economy slowed down, there wasn't a lot of fiscal and monetary help, the earnings of Alibaba Group and other Chinese companies dropped quite significantly, or at least stopped growing. And this is because a lot of, like 80% of its operations are within China.
On anywhere for anything. So how does it even work? Meet our fictional character, Jane. She lives in Beijing. Jane wants to buy a new blender, so she logs onto Taobao. She finds one she likes being sold by, let's say, Chris. He lives in Shanghai and sells the blenders to individuals at a competitive price. When Jane goes to check out, she doesn't use her credit card, she uses Alipay to purchase the item. Think of it like using PayPal. Chris then accepts the Alipay payment from Jane. So where did the supplier Chris get the blenders from? Well, he bought a supply of 1,000 units on 1688.com, the popular Chinese version of Alibaba.com. It sells bulk orders to suppliers like himself. He bought his batch from a manufacturer named Keith on Tmall, which allows businesses to sell wholesale. Keith owns a blender company and production facility in Shenzhen, which produces the items and other kitchen appliances. Previously, Chris only sold to individual buyers in China, but recently he's listed his blenders on AliExpress, which sells to customers outside of China. So now, Laura, who's living in California and found the blender on AliExpress, can also buy it from Chris. And yes, she can even use Alipay too.
Yeah, and little joke from me. You can see how all of those different websites are connected, how the products go from big producers, then to business retailers and business to customer retailers. And at the end, they even sell it on Amazon to other different countries. The joke is that after it is sold on Amazon, it goes, on AliExpress. After it is sold on AliExpress, it usually can be also sold on Amazon. So while there are a lot of products on Amazon and some of them are quite cheap, a lot of products that you can see on Amazon were before purchased on Alibaba and AliExpress and then are later resold for a higher price on Amazon. So yeah, be careful. If you are buying on Amazon, sometimes you can find the same exact thing for a lower price on AliExpress, meaning that you can save money on AliExpress, but you also need to be careful because you might be buying something of a maybe lower quality for a higher price on Amazon.
Of course, importing products from China into the US is nothing new. The difference, now anyone in the world can do it from their mobile device and all through the same company.
But it's not only e-commerce. Chris has been selling so many blenders lately that he wants to grow his business faster, but he doesn't have the money to buy more units from Keith. So Chris uses Ant Financial to get financing. The loan helps him order an extra 10,000 units. So for buying, selling, digital payments, and even financing, you've done it all in Alibaba's platforms. And Alibaba now includes a shipping company, a messaging app, a movie studio named Alibaba Pictures, and more. Alibaba's growth is primarily fueled by China's massive population and rising middle class, but Jack Ma wants world domination for the company. That's why Alibaba is investing heavily in companies in other markets as well, most of which are also being pursued by Amazon.
The marketplace as we know it has changed forever, and it's likely going to be companies like Alibaba which continue to lead its evolution.
Right.
Hey, it's Upton. Thanks for...
Thank you very much. That was a nice video. So yeah, as you can see, Alibaba has a lot of different companies and a lot of different websites that they operate, but also they have a diversified operational activity. So they're not only a marketplace where sellers can put their products, but they also do financing, logistics, and purchase companies from all around the world. Right, the second thing that Warren Buffett looks at are durable competitive advantages. So JD holds a strong competitive advantage over many other e-commerce companies because they have the logistics network. They own their own cars and warehouses, and they can, like Amazon, deliver their items next day or in 2 days. So it's very, very quickly, and as you can see, they're also using different types of technology like the drones to, for instance, deliver to some weird rural areas where there isn't a lot of good roads. All right, and now durable competitive advantages of Alibaba. So it lies in their ecosystem-based business model. So they combine e-commerce, cloud computing, digital payments, logistics, financing, and a lot of different businesses into one. So that also gives them diversification. So the inflow of earnings and revenues might be more stable because they have different types of businesses, but also everything can be done through their ecosystem. And also for JD.com and for Alibaba, a very important thing is that they are from China, so the prices of the materials and laborers are much cheaper, so they are a low cost producers. So all of the items that are bought on those websites can be better priced than the competition like eBay or Amazon, etc. So that's why they are winning. Right, next let's look at the quality of management for JD. The company's consistent execution in expanding logistics, improving delivery speed, and maintaining strong customer satisfaction, in my opinion, reflects a management culture focused on integrity, innovation, and long-term growth. In case of JD.com, the original founder stepped down from controlling the operations a few years ago, so it's similar to Alibaba Group, where also the Jack Ma, the founder of the company, stepped down. And Jack Ma, before stepping down, he established a very strong culture of innovation, adaptability, and long-term thinking. And he has built his team by choosing people who shared Alibaba's vision and complemented his skills. And what he likes to say that he likes to work with people that are smarter than him. So hopefully the people that are still in the company after he has left are top quality. Right, the next thing, number 4, that Warren Buffett looks at are consistent earnings. And here for Alibaba, we can see that the earnings are growing around 14% if you look at the trend line, or CAGR of around 8%. But what is the most important is the slowdown in recent years that also influences the averages. And the slowdown started after the COVID pandemic, so after 2020, but the price of the stock dropped significantly more than the revenues or profits of this company. So while we see stagnation in earnings per share in recent years, the price dropped around 70% from the top. So this is not correlated to the strength of slowdown in the company. However, if the value of the company is seen in its rapid growth and the growth slows down, that can be a good reason for a huge drop in price. But we'll look at the valuation later to see if this company is currently cheap or not. And for JD.com, in here it didn't calculate the growth speed, but we can see that this company wasn't highly profitable before 2020, and after the pandemic, when there were issues with supply chains, because they had their own logistic network, they managed to stay very competitive and didn't have issues with the supply chains. So this was very good for the company, and as we can see, the earnings grew rapidly after that. So JD.com, question is, are those earnings going to continue into the future? And in my opinion, the company was focusing before that on growing the revenues, so strictly growth, competing by having low prices. But right now, after some time of growth, they decided it's time to also get some money and actually generate a lot and stable profits. Right, let's look at the profitability next. So in here, the JD.com compared to Alibaba. Gross margin of JD is 16%. It's higher than the history, as we can see here. This is the gross margin of JD. So over the past 10 years, there was a growth. There's a growth trend line, meaning that the margins are increasing over time. So compared to Alibaba, for Alibaba, sadly, the margins has been decreasing. They were as high as around 70 in 2015. Right now, they are still at a huge level of around 40%. So 40% from Alibaba compared to 16% from JD.com. You can see that Alibaba is 3 times more profitable, but that's because they are in a little bit different segment. They just connect the seller to the customer for their online platform, while JD.com is more in logistics, transport, and warehousing. And we can see the net margin is currently at 3%, the operation margin at 2.4%, so this isn't looking great. Return on assets is at 6%, return on invested capital 7%. We can see those numbers compared to industry and history, so we can see that based on the history of this company, current margins are high. And now looking at Alibaba, we can see that those profitability margins are much higher, especially the 41% gross margin. The return of investment is 9%. For JD is around 7%, so it's similar. Return on assets is also nearly twice. So maybe not twice, but at least 50% higher. 5.7% for JD, return on assets, and 8% for Alibaba. So Alibaba is much more profitable business, at least right now. We need to also think about what is the potential for JD to increase their earnings in future years. Are they slowly increasing their margins, and is this trend that we can see here going to continue into the future? The growth of the margin isn't huge, but it's great to see that, while for Alibaba, sadly, we can see that it is stable and not changing much in recent years, and before that it was actually dropping. Right, number 6, we don't want to see risky debt, of course, while investing in stocks. Even if we have amazing results for hundreds of years and then we lose everything, we still are left with zero. So that's why it's very important not to lose money. All right, so debt to equity for JD.com currently is around 0.4, debt to assets of 0.13. This is very low. And if we look at the ratios, we can see that the current ratio, quick ratio, and even the cash ratio all are at good levels, and with the days inventory of around 30, which is low compared to history and to industry, we can make sure that this company has a way of generating money and paying back its debt. For Alibaba, it looks very similar. The debt levels are even lower, which can be a little bit weird considering the huge margins that they have. Maybe it would be better for them to actually get a lot of debt, invest that, and multiply it using that powerful 40% gross margin. But this company also has a lot of debt not debt, but cash on their books. So they are able to finance all their growth using the cash flow that comes from the operations. So debt to equity for Alibaba is 0.25, debt to assets 0.14, current ratio, quick ratio at 1.45, and cash ratio at 0.88. So both of those companies are safe to invest in. Alibaba even more safer than JD. Right, number 7, let's look at the price. Let's see if this company is cheap or expensive. When we look at the PE ratio, it is currently at 10 for JD.com. For Alibaba is 18, so it's higher, but we need to take in consideration the growth and the margins. So the margins for Alibaba are much higher. Let's look at the growth. All right, here is the growth of JD.com. We can see the revenue grew 34% on average over the last 10 years. For Alibaba Group, it is 30% per year. EPS, earnings per share, for JD.com grew 48% over the last 5 years, but this is because they were generating a lot of revenues without earnings for a long time, and now they became profitable. So for Alibaba, we can see actually the earnings didn't grow over the past 5 years, only 1% growth there. But if we compare the revenues, we can see Alibaba 14%, JD 12%. So actually the revenues for Alibaba grew quicker. And we need to remember that currently Alibaba is investing heavily. They're buying back its own stocks also, but JD does the same. All right. Let's go back to the valuation. We can see that the price to sales ratio for JD is 0.3. Price to book ratio is 1.5. So those metrics should be higher also for Alibaba because they have higher margins. Yeah, price to book ratio for Alibaba is 2.6. Price to sales also 2.6. So it is significantly higher for Alibaba, especially the price to sales ratio, because 2.6 compared to 0.3, wow, that's just a huge difference there. So there is a lot of revenues behind that stock price for JD.com than for Alibaba. All right, and now let's look at the history. So comparing Alibaba with history, we can see that the price to sales ratio and price to book ratio for this company and price to earnings ratio is currently low compared to history, and the same goes to JD.com, although in here we can see even bigger disproportions. So usually the price to sales, price to book, and price to earnings ratios aren't as low. Right, let's look at the chart. Here we have the chart of price to book value ratio for JD.com, and we can see that in 2016, 2018, that indicator was in range between 5 and around 13. After 2019 to 2023, it was in the range of 2.5 to 7.5. And currently we are sitting at a low of 1.5. So, yep, is it 1.5? Yeah, 1.5. So it is super low. But for Alibaba, it is similar. However, we can see that it isn't at the maximum lows right now. It went up to 2.6, as before it was around 1.8, something like that. And before that, the maximum price to book value ratio was around 10, and there was a range before 2020 that was above 4. So still it's quite inexpensive compared to history. Right, long-term prospects, so we already talked about it. The revenue growth is what we can look here, and book value growth for JD, revenue 34%, book value 24%, while the price over 10 years grew only 4%. So we can see as a huge negative correlation there, with the price growing much more slower than revenues and book values. And something similar can be seen too in Alibaba, but in here the price grew quicker, 9.6%, because look here, at the last year the price rose 82%. But the revenues and book values are increasing on average over the last 10 years at a similar rate, a little bit slower than JD. Right, and now 9 shareholder friendly policies. Let's see if this company is friendly for its shareholders. So what I mean by that, they pay dividends, they repurchase their shares when they're undervalued, and the management is sane, is doing good things, and isn't doing things that are bad for the shareholders, like for instance liquidating their positions by issuing more shares. So let's look. In here we have dividend and buybacks for JD.com. We can see that the dividend yield is 3%. And 3-year average share buyback ratio is at 2.3%. So they are doing both of those things. Dividend yield history, currently this company is paying around 3% dividend, so higher than the average over the last years. And as we can see, the dividend, they also only start paying dividend in 2013, but it is growing. Similar stories for Alibaba Group. Dividend yield 0.7%, so much lower than history, but 3-year average share buyback ratio 3.8. This is higher than JD because JD had 2.3. And yeah, dividend yield history. Currently, the dividend yield is around 0.7% per year, so this is very low. But you can also see that this company is paying only a fraction of their earnings in dividends. They prefer stock buybacks, which is good because dividends are double taxed. And also, only in recent 2 years, this company started paying the dividends. All right, and let's go to the bonus section, which are cash flows, something very, very important to look at. And let's start with Alibaba. In here, we can see that this company is generating huge earnings from its continuous operations. Those numbers are growing, although not steadily. We can see some ups and downs over the years. Change in prepaid assets also in recent years dropped quite significantly. But yeah, what I like to see is a big difference between cash flow from depreciation, amortization, etc. So this number compared to this number in net income from operations, we can see that it is around 30% of all of the net income from continuous operations. The lower the depreciation, of course, better, because that means the assets are more valuable and they are able to produce more money. But as we saw previously, Alibaba has return on assets of around 10%. JD.com, that number is lower, sadly. So yeah, good cash flows from operations every year, they are positive. For cash flow for investing, in here I just love those numbers, especially in 2025. Just the huge numbers in purchase of investment and purchase of property, plant and equipment. This is something that I really love to see. And cash flow for financing, repurchase of stock, also huge numbers over the last 4 years. And net issuance of debt. In the last year, they issued some debt, which in my opinion is actually good because they have good return on assets, good gross margins, so they can use this debt productively. And yeah, cash flow for dividends, we can see they also have it. It's growing, but we only have 2 years. But I like to see that this number is much lower than the repurchase of stock. I think repurchase of stock, especially when the stock is low, is much better. Of course, when the stock goes higher and is overvalued, then it's not good anymore. But purchase of stock is much better than dividends, in my opinion at least, especially with low price of Alibaba stock. And now coming to JD.com, we can also see that their net income from continuous operations is growing, especially look at this 100% increase from 2023 to 2024. But previously we can see also negative years, so that means that this company is a little bit more riskier than Alibaba. But we also get lower price to earnings ratio. With similar growth, even JD is growing a little bit quicker. But what we need to understand is that the margins of JD.com are sadly lower, but that might be because they are just entering into their profitability stage, with the margins growing every year a little bit, while the margins of Alibaba are stagnant. And now the most important part, so investments. What I can see here is that the investments slowed down a lot in 2024. So sadly we cannot look at this part. It's not, well, we should look at this part, but as we can see, it's not very promising compared to years 2023, 2022, 2021 and 2020, when the purchase of investments was much greater than sale of the investments. And it is important that sometimes maybe it's good to sell a company. They don't have any money problems, any debt problems, liquidity problems, so they are just maybe realizing their profits, taking the profits as again in this year, and we can see that they're also still buying a lot of investments. But in my opinion, at least the last year doesn't look so good. But yet those cash flows are massive, and look, they have around 3,000, 1,000, 7,000 of that net income from operations. Or if we could look here at cash flows from operations, it's around 6 to 8, and those numbers, cash flows from investing, are even higher than those from cash flows from operations. But when we come to Alibaba, let's see, we have numbers 22, 25, 28, 22, and from investments 25, in here only 3, 20, 31. So yeah, those numbers are also not always, but sometimes higher than the operations. But let's see at JD how much are they paying dividends and how much they are repurchasing of their own stock. We know that they are doing that, just let's see to what extent. Oh yeah, so cash flow from financing doesn't look as promising. Of course, they have repurchase of debt in repurchase of stock in 2024, payment of debt, issuance of debt. So they're issuing debt a little bit over the past 3 years, and they're spending on dividends. So yeah, the cash flows are looking all right. However, it seems like they're not in a stage of giving more value to the shareholders by repurchasing stock and paying dividends, especially into 2020 when they had a lot of debt and other financing. But they're still a company that looks to me more focused on growth factors. So sadly, in here for the JD, we don't see exact numbers for 2025, but for the two quarters that I already reported, it looks like the cash flow for investing is actually positive. So they are bringing more money from the investing that they are investing. So it is good short term, but not so good long term. While cash flow for financing still looks negative. So that might be repurchase of stock, maybe continuing into the future, maybe payment of debt, or cash flow for dividends. All right, so that's all. A little conclusion. I think both of those companies look very promising. JD.com has a little bit higher growth, with the price being much lower, especially the price to sales ratio of just 0.3 compared to 2.6 of Alibaba. There's like 6, 7, 8 times, around 8 times lower. So we are getting a lot of revenues while buying JD.com, but this is of course because of the lower profitability ratios of this company. Right, so considering all of this, both of those companies look good, but we also need to take in consideration that Alibaba.com grew in price. The price grew rapidly over the last year, which before that I would say that Alibaba was certainly better, but right now the JD has in comparison significantly lower price. But the most important part is to think about what will happen to JD earning power in the future. Are those margins going to grow, and how fast are they growing? Currently, the growth of the margins for JD.com isn't very quick, but it is growing, while for Alibaba it's more stable. But hopefully with the new investments into chip manufacturing, similar to Nvidia, etc., probably those margins will also go up. All right, thank you very much for listening, and I hope this episode will help you invest better.